Markets take a breather after 2 days of relentless rallying. Perhaps a lull in the headlines can be the reason why we have a little bit of a stall here today, but headlines resume with all kinds of interesting information come less than 24 hours. That's what we're going to focus on here as we take a look at what is perhaps the reason that we've stalled here and why we've stalled where we have, and then take a look at what comes next. The U.S. retail sales report, of course, front and center data-wise, but much more importantly, it'll be key to digest just what that data is going to show in the grand scheme of things, beyond just a number that crosses the wires here. So let's take a look at what's going on and why this matters in the context of where we've ended up. Here's the S&P 500 here, and we can see we start this week with a blistering rally. We extended for a second day yesterday, and then we stall as of today. The stock market here and the S&P as a kind of general barometer of overall risk sentiment, basically finishing the day flat after these surges here. And how we got here is not exactly a secret. We can see here, this is the financial stress index from the Office of Financial Research. This is within the Treasury Department. And what it does is it gives us this indicator of financial market stress, and it breaks it down by various contributors. And we can see that financial stress absolutely surged in the first part of April, and that market volatility around the implementation of tariffs was the catalyst. We can see the volatility component of this index absolutely surging. It has now been worked down to basically nothing, and in fact, volatility is now starting to be a reason for this index to move lower. Credit conditions are the loosest they've been since March. Equity valuations are not a big consideration in this calculus. Neither are funding conditions. The state of safe assets here looking better, and safe assets, of course, speak mainly to government bonds, so sovereign stress not really a major issue in the equation at this point. And so, needless to say, we have an understandable sort of a euphoria here as we get what is essentially a de-escalation of the most important part of the trade war, the U.S.-China spat. Now, it does put a cliffhanger on the situation until August, because the pause in the worst of the tariffs is 90 days, but it does mark an important indicator of intent, whereby both sides walk away from the worst of the conflict. The U.S. cuts tariffs on China from 145 down to 30 for 90 days. China cuts it down from 125 to 10 for 90 days. We clearly get a sense that there's a desire for an off-ramp from both sides of the dust-up here. And so with that, the markets, of course, come away happy relative to where we were before there was that kind of a quick reset, perhaps, but certainly a helpful change of tone after a 2-day meeting from Treasury Secretary Scott Bessent and U.S. Trade Representative Jameson Greer and their Chinese counterparts in Geneva over the weekend. Then, of course, we get U.S. CPI data, and as we can see, that motivates another bit of upside momentum, albeit more modest. And that is because we get a U.S. inflation data report that basically looks normal. It doesn't look like there is a dramatic distortion here from the trade war. The concern, of course, was that maybe there would be some sort of an eye-catching jump in the price of goods having to do with all these trade barriers getting passed on to consumers, and that isn't what we see here for the moment. We can see headline inflation holds steady, 2.8% for a second consecutive month, as expected. The core, the headline comes in actually a little bit lighter, 2.3% versus 2.4 expected. And we can see in the makeup of the report that it's still mostly services. That is, of course, where most demand is, so that makes sense. In fact, the contribution from services has cooled a little, and in a sort of the kind of moderate way that the Fed wants to see. The Fed has been trying to get the service sector to cool as a precondition to get inflation back to 2% for some time. So clearly, this is welcome news, and whatever surge in goods inflation might have been anticipated is very clearly not here. So with that in mind, we have a situation here where the story seems to be that, for the moment at least, we have a normal kind of inflation profile. And what that then means is that we likewise don't have an emergency that might beckon the Fed into action or otherwise kind of take things off kilter. And of course, the markets like that. In fact, what we've seen is that stocks have rallied even as Fed rate cut expectations have moderated. We can see now the market is at around 80 to 90 basis points for the year. And next, taken together, that generally comports with what the expectations for policy look like from Fed officials themselves. They are looking for 50 basis points this year, 50 basis points next. We're very close to there. And in fact, the markets are now slightly less dovish relative to the Fed's own projections, which is, of course, a very dramatic about face relative to early April, where all of this volatility was occurring, and the market was demanding that the Fed do much more easing. In fact, 137 basis points in total, which we kind of take a simple sort of arithmetic to it, is 1.5 times pretty much where we are currently. So we're looking at a very significant unclenching in markets, but of course, the real question, as ever, is about the economy. That's where we find ourselves now. Because again, critical to the architecture of this decline is when it begins and when it doesn't. The markets knew that there would be tariffs. They balanced those tariffs against the prospect of deregulation and tax cuts, that is, policies like the trade war that are growth negative against policies like deregulation and tax cuts that are growth positive. And they were simply not panicked when they knew that that was the policy trajectory back in November when the election was settled. In fact, they actually rallied into and after the election until we hit a high somewhere in the early part of December. Where this sell-off starts very tellingly precedes Liberation Day, precedes the worst of the tariffs. Rather, it speaks to where the economic data in business and consumer confidence surveys starts to turn. And we start to get this sense that what we're looking at here is some kind of an economic deceleration of consequence. The PMI numbers that we've looked at here from both S&P Global and ISM very clearly suggest that over the course of the first 4 months of the year, the economy basically ran down into standstill after some of the fastest growth in years in the second half of last year. And so with that in mind, we are looking now at a situation where we've arrived back to essentially that starting line. And so if this was a sell-off about growth, this is sort of where that moderated and settled, and then this really gets us into Liberation Day and sort of the more hair on fire portion of this move, where investors are reeling because it looks like the US is trying to extricate itself from its role as the global reserve currency, the key currency of commerce, and indeed the provider of the world's risk-free asset, the Treasury. Once that sort of runs its course and it becomes clear that the administration is not intent on doing those things, that it is amenable to market discipline, that it is not its intent to essentially have the foundation of what is the global financial system get dismembered from within the place that built that foundation, we then see the markets obviously unclench, and we're back to where the growth scare generally left us, in this area. So now the question, of course, comes, well, the cliffhanger on the reciprocal tariff pause above 10% is in early July. The one on China's tariffs is in August. Between now and then, trade war looks like it might fade into the rear view, at least take a more background role in the narrative. And the question becomes, well, what's next? Where is the economy now that the dust on this part of the story appears to be settling? Are we still concerned about growth? And with that in mind, we turn to a check on U.S. consumers via the U.S. retail sales report. And the expectations here point to a deceleration. They suggest that we're going to get 0% growth month on month in April's numbers, down from 1.5% in March, which was, as we can see here, a meaningful jump, the largest one that we'd seen since back here in the latter part of 2022 going into 2023. So the increase here, obviously a large one, and perhaps against the backdrop of such an increase, it does make sense to see a bit of a cool down. But if we look at the expectations for the year-on-year numbers, they're more dramatic still, and they are pointing to the weakest year-on-year trend growth since we can look back to sort of early 2024. So with that, we have a curious kind of a situation because, of course, the main driver of U.S. economic growth is household consumption. In fact, the latest GDP numbers give us a share of consumption in overall output growth at 68.5%. So this is a critical input into where the economy actually is, tariff this, tariff that, headlines notwithstanding. Now, how did we end up with this 1.5% surge? Well, that's actually a very important part of this calculus. If we look at the breakdown for where we were in March, we can see that there was a dramatic 5.3% surge, off the chart really relative to everything else, in motor vehicles and auto parts, which is a part of this category here. Now, if we consider sort of this a bit noisy, we can bring it down and say, well, here's how much retail sales increased overall. Here's that 1.5% jump. Here's the jump in motor vehicles and parts. Obviously, this is a much larger increase here. That's that 5.3% right here. Here's retail sales excluding energy. So it's a little bit better than the overall. We can see energy was a little bit of a pull down. And here's the control group here. Now, the control group excludes auto parts, excludes autos. And we can very clearly see just how modest this was and just how much uplift to this thing came from auto parts. In fact, the index here, excluding auto parts completely, gives us a very modest retail sales rise of just 0.6% in the last reading. So obviously the question is, well, why auto parts and why vehicles? Why this surge? And that, of course, comports with the announcement of tariffs on that very sector. Tariffs that have not gone away. And so what this does, in a sense, is it demonstrates the willingness of consumers, not just businesses that have been front-running the tariffs, but of consumers to look ahead, expect that tariffs will make things more expensive, and to try to squeeze in consumption before that happens. And of course, we saw this in spades in the first quarter GDP numbers, where we saw that we had a dramatic build in imports and a dramatic jump in inventories. That's a part of this investment component here, as companies tried to front run tariff increases to try to stock up before prices go up. At the same time, however, the biggest component, as we've just discussed, consumption, that contributed the least to overall growth in almost 2 years, going back to the second quarter of 2023 here. So the key question then seems to be whether consumers are willing to continue to front run with businesses. And the April numbers, again, they seem to suggest that the answer is yes, right here. And if we now have an environment where, as of April, there are more tariffs to front run, then perhaps this extends out across all categories of goods where you have significant imports as a part of the mix. And of course, it's mainly about goods, the imports story. Most services demand is serviced domestically. So one might surmise that if there in fact continued to be front-running in April, then this is much too low. We might get another heady number here, which of course would be very supportive for stock markets, one would think, because it would suggest that consumers are still willing to be buyers, even though this risk looms, and maybe because this risk looms. And that this will then continue to power the economy. In fact, the tariff threat may be a kind of goading for the economy to power ahead, because it is spurring, in the short term, this front-run consumption. However, we don't know that that's in fact going to happen. And indeed, we can see here from the consumer confidence numbers, consumer confidence is melting down. Largely, it is melting down because the expectations are that indeed the tariffs will be a major price shock. In the latest set of U.S. consumer confidence numbers for the month of April, we have here a 6.5% 1 year forward inflation rate expectation, which is miles above even where the COVID top was in 2021 for consumers' inflation expectations. So, and we'll get an update on this on Friday, and we'll talk more about it on tomorrow's show in the context of retail sales numbers that will have already come out. We'll have a little bit more insight in what this has done. But we can see here that we can do both things at the same time. We can have very negative sentiment, and we can have this front-run consumption. But again, whatever front-run consumption there is, it is important to consider that all that aside, or at least all that notwithstanding, we still have this slowdown in consumption. And that would be the real recession risk in this environment. Because again, this is by far the biggest contributor to overall growth. And that makes this retail sales number very, very interesting in the context of where we've landed on stock markets. If, in fact, the front running continues and consumers continue to soak up purchases, if only because they're anticipating tariffs downwind, now that those expectations have moved out into July and August, there's a lot more room for consumers to keep front running and for that buying to keep the economy on relatively solid footing. If that's the case here, if that's what these numbers say, well then stocks may well have some impetus to continue going higher. If on the other hand, we get to the April CPI or the April retail sales report, and what we find is weakening demand, which is what you might think you'd find, considering, again, there is no major pull on goods here, which is, of course, encouraging if you were worried about a tariff shock, but discouraging if what you're looking for is just demand for goods in general. And certainly, since services make up a larger portion of the economy and this component is cooling, you again get a sense that demand is in fact winding back. If what you end up with here then is the sense that, well, the panic is over, but nobody said anything about undoing the slide lower on growth, that is happening outside of the fire and fury of the news cycle, then stocks might feel like they've gone too far here. And a correction, perhaps with some legs, may ensue. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Likewise, on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones Tuesdays for the Price of Truth. Incidentally, Chris will be there in just 30 minutes time from now, so definitely check that out. Back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow.